Welcome to Wealth Rounds. Today we're exploring advanced corporate architecture with two vital tax mitigation questions for an attending physician earning 1099 income from moonlighting or extra shifts. First, if you utilize a standard SEP-IRA to shield your independent contractor income, why does that choice mathematically require you to earn significantly more revenue to hit the exact same tax deduction provided by a solo 401k? Second, how can nesting your independent income inside a formal corporate entity unlock an immediate deduction for your private medical malpractice premiums while simultaneously supercharging your retirement tax shelter? Let's look at the case profile. The profile is an attending physician making $400,000 a year at their primary hospital. They take on extra independent shifts, generating $50,000 of gross 1099 income. To mitigate the tax drag, they open a SEP-IRA, assuming all self-employed accounts are structurally identical. The diagnosis is suboptimal corporate capital allocation. To resolve our first opening question, a SEP-IRA only permits employer non-elective contributions, which are strictly capped at roughly 20% of your net self-employment earnings. To shield just $10,000 of taxes in a SEP, this physician would mathematically need to net $50,000. Conversely, a solo 401k allows you to act as both the employer and the employee. Even if you max out your primary job's 401k or 403b, a solo 401k allows your business entity to layer on an additional employer profit sharing contribution of up to 25% of corporate compensation. This allows you to reach maximum statutory caps much faster and with far less gross revenue. But here's the answer to our second question, and where a true tax mitigation planning approach creates a powerful synergy. Instead of receiving 1099 checks in your personal name, that revenue from extra shifts is routed directly into a single member LLC that houses your solo 401k. Because private medical malpractice insurance is an ordinary, necessary, and direct cost of practicing medicine, your LLC can pay those premiums directly. This converts a personal professional overhead cost into a direct corporate tax deduction, aggressively suppressing your net business income before it ever hits your personal tax return. The treatment plan is institutional entity structuring. The business wrapper surrounding your income has to facilitate your goals. You capture the 1099 revenue through an LLC, deduct your malpractice overhead at the corporate level, and sweep the remaining net earnings into a solo 401k profit sharing chassis. You structure the entity, minimize the corporate net income, and maximize the retirement tax shelter. That's how you execute true intermediate wealth architecture. Comment Solo Engine or send me a message to evaluate your 1099 corporate entity structure for 2026.